My name is Adam Foard. I'm a shareholder over at RandAcpas, and this sort of end of year tax planning, looking ahead to the tax liability, is something that we do every year for all of our clients, and particularly this year with the what you guys do with the tech startups. There's some changes this year that are going to affect the taxes that I'm going to mention here that are pretty substantial changes. Mainly to do with the R&D credits, but I guess I'll go ahead and jump right in here. So I'm going to be looking at four main things for year-end planning. Once we get to this part of the year, there's not a whole lot that we could do with the time that's left, but there is certain things that we can think about and certain things that come the tax return that we want to be sure are getting on there, and we are getting all the credit and deductions that we can. So the first one here is, basis of accounting. And generally with taxes, you have two choices, right? We can do the cash basis of accounting, which is how it sounds. When you get the cash, we're picking up income. When we pay the cash, we're getting the expense. And then there's the accrual basis, where we recognize income when it's earned and expenses when they occur. So why does this matter for you guys in particular? And I think Anita mentioned it at the start of the presentation. What happens if I get a grant on December 30th for $500,000 and I have no expenses to go against this? Am I going to have to pay taxes on $500,000? What do we do? So this is where it's really important to pick the right basis of accounting. And for you guys, I generally recommend the accrual basis. And what that is going to allow is, if we get this $500,000 at the end of the tax year with no expenses, say it's for a grant period that's for all of 2023, we can defer recognizing any of that income until 2023. So it's a major tax savings that we can match this income up with the expenses that are going to occur in the following year. So it's important. This is generally decided, when you file your first tax return, you pick your basis of accounting, whether it's the accountant that's picked it or they've talked to you about it. Hopefully they've talked to you about it. It's generally done on that first return, but we can change it. So say you were cash basis last year, and this year we've got a big payment at the end of the year. You could still file this year under the accrual basis and defer that income. And we would have to file a special form with the tax return this year. But it's definitely something you want to be keeping track of, as you're coming into the end of the year and maybe reviewing last year's taxes. Or if this is the first year that you're filing, talking to your accountant about, okay, what basis are we going to use and how is it going to impact me tax-wise? The next piece here is with regards to any large asset purchases. So this year for 2022, if you buy anything equipment-wise, vehicle-wise, that is over $2,500, which is the IRS minimum, you can expense 100% of it. So if you buy a specialized equipment for, we'll just throw a number out, $50,000, we can write off 100% of that $50,000 this year. And that would be the same whether you bought it with cash or if we debt financed that piece of equipment, we could still write off 100% of it. That 100% write-off is going away, and in the next 4 years is going to drop down 20% each year until we get to the post phase-out time, which is 2027, and then we have to depreciate them over, depending on what the asset is, 3 to 5 years. So what we're looking at now is timing this purchase, if we can, to be this year, in order to get that 100% write-off and not lose any of it once we get to 2023. So it's a matter of looking forward, saying, what are my purchases how can I bring this into 2022 in order to get my 100% write-off now, to ensure that, oh, my screen popped, sorry about that. To ensure that we're getting all of the write-offs we can this year and deferring the taxes till later down in the year. This next slide is going to be pretty busy. I'm going to try to hit the high points, and hopefully you have heard of this topic before regarding the R&D credit. So with you guys being in the tech startup space, generally all of your costs should be R&D credit available. Generally, we're looking for anything that's newer, improved, performance, reliability, quality of a product, and eliminating any uncertainty. So if you guys are getting grant funding, developing new products, generally your activity is going to qualify for the R&D credit. The one thing we want to be careful about is reading the grants specifically. Not all grants are going to qualify for the R&D credit, because in order to qualify, it has to be what they'll say is not funded research. And generally, from what we have seen, funded research is anything along the lines of a cost plus grant or contract, anything fixed fee, fixed price grant, where any additional costs or incidentals that would needed to be paid for, you would be covering those and you wouldn't be getting any additional money from the grant. So it's really reading your grants specifically and seeing which ones qualify. If you have any SBIR grants, generally phase 1 is a fixed fee grant and should qualify. We've seen a lot of the phase 2 and phase 3 have become that funded research category and no longer qualify. So it's a matter of getting with your accountant, reading the grant and making sure that we qualify. And then if we do qualify, there's certain expenses that are going to be allowed to be taken towards calculating this credit. And these are going to be qualified research expenses. Generally, what those are going to be is you're going to get 100% of any compensation paid to employees that are engaging in the R&D activity, 100% of any supplies used to conduct the research and development, 65% of third-party contractors that you guys are using to assist in the R&D, and then 75% of any payments made to educational institutions. And once we take the sum of all of those items, we generally get a 20% credit above a base amount. And for startup companies, it's generally going to be 50%. So if we had $1 million in total expenses, we would cut that in half down to 500,000, and then we would calculate our 20% credit on that amount. So we'd be getting a $100,000 income tax credit to help offset any income taxes or potentially payroll taxes with that amount. And I had mentioned previously that we do have some rule changes with regards to the R&D credit. So pre-2022, all of the expenses or all of the qualified research expenses could be directly expensed. And so generally we think, okay, we've got $1 million in grant income. We've spent $1 million on all of our expenses. We're at a net zero. Sounds good. And pre-2022, that's how it would go. But for 2022, this was a change that was in the Tax Cuts and Jobs Act way back in 2017. We now have to capitalize any qualified research expense and amortize it over 5 years. And that's for any expenses or any work that is being completed in the United States. If we have anybody that's working outside the United States, those costs need to be amortized over 15 years. So I guess we look at that and we think, okay, why would they make this change? And as we're looking at it, they made a lot of large tax cuts in the Tax Cuts and Jobs Act, and they needed to make up some funding somewhere else. And this is the change they went to in order to recoup some of those tax cuts that they gave out. You know, we were hoping that by this time they would reverse this change, because it is really, you know, disencouraging people to perform R&D in the United States because of these changes. And I'll show you an example here of what that looks like. So on the left here is the pre-2022 rules, where we'll look at, okay, we had $1 million of grant income. We had, we'll just put a number out there, 200,000 of R&D expense. We've got a net loss on the year of $1 million, right? So we've got no income taxes due. We do get the R&D credit for those expenses, which comes out to 200,000, which is again the 50% of the 2 million at 20%. And in those rules, we would have been allowed to apply that to any payroll taxes that you would have had. So if you had W-2 employees and you paid any Social Security and Medicare, we could recoup those with this tax credit. And that was under the pre-2022 rules. And the new rules that have come into place are on the right-hand side here. We can see same exact scenario. We've got $1 million of income. We've got 200,000 of R&D, 2 million of R&D expense, but now we have to amortize that over 5 years. So we only get a 200,000 deduction in the current year, which gives us 800,000 taxable income, generating 168,000 in tax. Now the credit still comes out to 200,000, and we're a little bit overpaid there by 32,000 on the income tax, which will carry over to the following year. But the change really, what it did is it prevented us from getting money back on the payroll tax side. So that's how the government is utilizing this as a tax raiser. Is no longer are they going to be paying out to small startups for their payroll taxes. It's a terrible rule change, one that all the organizations have been fighting for to get removed or reversed back to the old rules. But as of this point in time, nothing has changed. So it's very important now that, you know, all of the documentation is done on the research and development. Let's claim all of these costs in order to drive up that credit, so that we're not having to pay any income taxes, because it doesn't make sense. The rule doesn't make sense, and until they change it, this is what we have to go on. But so it's just a matter of, let's get everything documented. Here's my R&D. Here are the expenses that qualify. Here's how I'm going to generate the largest credit. So this was an example of a C corporation, which you guys, I don't know how everybody is structured. You know, a C corporation is going to pay tax at the entity level, and nothing is going to be paid by the owners themselves. So there's one option. The other option here would be a pass-through entity, and just how it sounds, all of the income and expense is going to pass through to the owners or the investors, and then the tax is going to be paid at the owner or investor level. So there's a slightly difference here. You know, same thing. We're looking at the pre-2022 rules on the left, would be no different from the C Corp, but the 2022 rules are a little bit different when we talk about a pass-through entity. And really the two items that we're looking at that are different are, one, the federal tax rate is higher, the max rate, right? So the max rate for individuals is 37% for this year. as compared to 21% for a C corporation. Another difference is something I'll talk about on the next couple slides here, which is the QBI deduction, or the qualified business income deduction. In previous years and under the old rules for R&D credit, any startup companies that were pass-through entities likely didn't need to think about or concern themselves with the QBI deduction, because we were always operating at a smaller income point, maybe a loss due to the R&D, or we were matching up the expenses with the income, and it wasn't as big of a concern. With the ones we had, most of the time that didn't really come into play. Now it will, because of the increased income these new rules are going to generate. So in general, and then we can go on to the next one there as we're looking at it. The qualified business income deduction, you get 20% of whatever your net income is for the year. And there's a couple limitations that might lower that amount. Generally, it's going to be 50% of your wages, or 25% of your wages, and 2.5% of your business assets. And there's just a couple of examples that we'll go through that show how this calculation is done. So in this first example, off to the right, I've got the limitation calculations there. So we have wages at 400,000. 50% of the wages is 200,000. Continuing with our example from the previous slides, we have $1 million of income, 200,000 of expense, and now we're sitting at 800,000 of net income. So our 20% of that is 160,000, which is less than 50% of the wages. So we're going to get a full $160,000 deduction, dropping our taxable income down to $640,000. Here's a slightly different example where we look at where we actually have the wage limitation. So we've got 800,000 of net income, 200,000 of wages. Half of that's 100,000. Our 20% is 160. So now we're only limited to the $100,000 deduction. But again, this is going to be calculated at the individual level, but it's all based on the income from the business. So it's one of those things where when we're looking at the tax return, we want to be sure that we can get this net income number as high as possible for this calculation. There are certain deductions that are allowable for the tax return that may not reduce the taxable or net income for this calculation. So it's a matter of discussing with whoever your tax accountant is, and making sure that, one, this deduction is being calculated and that you are utilizing 100% of it. Because with the new rules, the R&D credit is going to be less valuable if we don't add this deduction onto your return. So that's the last slide I have. I did want to mention just a couple other things here before we get into questions. I wanted to leave enough time for specific questions that people had. Other items that we can look at that Anita were mentioning is getting ready for next year is, if you had any 1099 contractors or independent contractors that need to be issued a 1099, be sure to get the documentation now, as those are due at the end of January. Generally we'll need just a W-9 form filled out by them, which is a pretty straightforward form. and pretty standard. They should be able to fill that out for you. If they don't, that's where we get into withholding issues for next year. So if they don't give you a W-9 and you can't issue a 1099, you have to start withholding 30% from whatever you pay them.